Good morning. Welcome. This is the Williams Mullen Annual Benefits Forum, and my name is Mark Purinton. I'm the chair of the Employee Benefits and Executive Compensation Practice Group here at Williams Mullen. I'm being joined today by my colleagues Nona Massengill, Bryden DeWitt, and Claire Pollock. On behalf of our team, I thank you for joining us for our forum. And while we're disappointed we weren't able to be together in person, we're delighted we have so many people joining us virtually. And before we begin our program, Claire's going to give us some housekeeping items.
Hi, thank you, Mark, and welcome everybody. So just a quick review. If you have questions during the program, go ahead and use the Q&A feature at the bottom of the screen. Nobody else will see those. Those are private questions, so feel free to go ahead and ask us questions directly, and we will see those. We'll answer the questions at the end of the program, time permitting. If we cannot get your questions, we will follow up with you directly. And if you have any technical issues right now, go ahead and also use the Q&A button at the bottom of the screen, and we have somebody who can fix those for you. So later today, a copy of the presentation will be emailed to you. And as you knew when you were registering, the program is valid for 1.5 hours of SHRM credit. So your email later today will also have the information about the SHRM credit.
Thank you, Claire. The theme of our program today is ERISA Superheroes. We hope the information that we share with you will help you with your daily challenges and perhaps a few villains that confront you. Today's program will begin with Bryden discussing health and welfare audits, Affordable Care Act reporting issues, supplemental voluntary benefits, and a very hot topic right now, vaccine incentives. Also, Nona Massengill will be discussing non-qualified plan elections, and then Claire and I will be ending with information regarding qualified plans, a variety of issues, including missing participants. We will answer questions at the end of the forum after all the presentations, but before we go to the formal program, Bryden will lead us in some Q&As. Actually, it's a poll.
Yeah.
Poll time.
Well, thank you, Mark, and good morning, everyone. It is poll time. In line with our theme, we'll kick off our first poll accordingly. Who is your favorite superhero? Captain America, Wonder Woman, my employee benefits attorney, or all of the above? And so we'll let you you vote on that. And you know the one we're rooting for. But every year we like to have a theme for our employee benefits forum, and usually it's something like ERISA recent updates to ERISA fiduciary regulations or something like that. So this year we thought we'd make it a little bit more exciting with a superhero theme, which may or may not have been influenced by the fact that during COVID, when my sons were home from college and my daughter was doing remote high school from home, and we were working from home, we started watching all of the Marvel movies in order. So it's kind of influenced me, at least in the theme for this year. So for our first poll, I see we have 85% of you have responded. And my employee benefits attorney has won with 47% of the vote so far, followed by all of the above, 29%. So that includes the employee benefits attorneys. Wonder Woman is at 15%, very understandable, and Captain America, he's okay. So he got 9% of the vote. But we really should contact Marvel or DC to see if we can have them add an employee benefits attorney to their lineup of superheroes. Maybe join the Justice League, because the villains out there are not compliant with ERISA fiduciary duty. More than likely. So let's. So I guess we'll go to the next question, which is a little bit more more in line with what you guys are concerned about. Stephanie, if we go to the next poll.
Sure. Give me 1 minute. I'm having a little bit of technical difficulties with it.
Okay, no problem. I thought it was me. So
Sorry, guys, I think we're gonna have to skip this second poll, but I'll try to fix it for the next one.
Okay, we were just, the next poll, we were going to just ask you, what's your benefits villain? What if your benefits attorney is your superhero, what is the issue that's really affecting you? And we're thinking of things like health and welfare reporting, engaging your employees, employee participation in your plans, qualified plan errors and compliance, and non-qualified plan compliance are some of the options that we had. So we'll just move on to the first section of our program. So as you can tell, we watched the Marvel movie, so some of my slides are very influenced by my now extensive knowledge of the Marvel universe. And I thought this was an appropriate segue into the first topic of individuals who may be covered under your plan, but they shouldn't be there. They need to exit the plan. You're going to have to ask them to exit the donut and get out of your plan. Let me move this. Studies show that up to 15% of dependents enrolled in employer-sponsored group health plans are not eligible for coverage. And so how does this happen? Well, part of it is your employees aren't necessarily communicating with you. And it's not that they're trying to lie or defraud the plan or anything. It's just life happens and they're not paying attention to who is necessarily eligible under your plan. They may not really know what the plan's rules are, and they have a child who lives at home and who's turned age 27 and is aged out of the plan, and they just aren't thinking about it. They just have enrolled in the plan. They go year to year, and this dependent who's no longer a tax dependent and no longer a dependent as defined under the terms of your plan is still there and still getting a card from Anthem or Cigna and still being technically provided benefits under your plan, even though they've aged out. Or there's a divorce situation, and the last thing they're thinking about is who's covered under their health plan. And so the employee doesn't tell their supervisor, or they don't report to HR maybe for several months or more or ever that they were divorced and that the spouse should no longer be covered under the plan. Or they've listed as dependents during open enrollment just individuals who are not dependents as defined under the terms of your plan. Maybe a niece or nephew is living with them, or let's say they married and the new spouse has a child who lives in the home, but our employee has never formally adopted the child. But they consider that child to be their child, and they enroll, during open enrollment, they list the child as a dependent. Or your plan doesn't provide for domestic partner coverage, but they're domestic partners and they've enrolled someone who isn't a spouse, or they consider the person to be a spouse, but they've never actually been married under state law. They're not legal spouses, but they've enrolled that person into your plan. And most plans aren't asking for marriage licenses or birth certificates or evidence that what the employee, when they do the online enrollment and they list people, isn't really, the plans aren't really asking for the information. It's a lot easier to enroll a dependent in a health plan than it is to sign up a child for Little League, as I know, being on the board of a Little League, where Little League requires you to have a birth certificate and 3 proofs of residency. That you can enroll someone into an employer's health plan by just saying this person is a dependent. So that's how it happens. And that's how we get to this figure of up to 15% of the dependents enrolled in your plan don't belong there, and they need to be out of the plan. And so let's think about, why does it matter? So what? We have an insured. Our plan is fully insured, and we pay it's up to the insurance carrier to pay the claim, or our plan's self-funded. We control who belongs in our plan because our plan is self-funded. Well, it still matters because, and on this slide, I just pulled at random a couple of provisions from the first one. The top one on the screen is from a stop-loss policy. So if you have a self-funded plan, the employer is responsible for all the claims paid under the plan, right? The employer is to pay the claims out of its general assets. And then the employer will then insure that risk by getting a stop loss policy. So there's an insurance policy that it's not protecting the plan participants. It's not a policy that is paying benefits directly to participants. What it does is it protects the employer from the employer's liability under the self-insured plan for large claims. So there's a window where the employer is paying these claims out of its own assets, and then it files a claim with the stop loss carrier for claims that exceed the maximum amount into the self-insured corridor. So if you have, when you sign up for a stop loss policy, the stop loss carrier asks for the plan document, right? When they rate your plan, when they come up with the premium for your plan, they are doing it based on your plan document, who the employer tells the stop loss carrier is eligible under the terms of the plan. And that policy only protects the employer against proper claims under the terms of your plan. So if your plan defines the term dependent one way, and you have people who don't satisfy that definition, who are covered under your plan, who you have offered coverage to, who have been enrolled in your plan, and those individuals have large claims, it's possible that the stop loss carrier, if they catch it, it's definite if they catch it. If this is caught, the stop loss carrier will not cover that claim. And so the employer will be on the hook to self-insure without the stop loss protection. And then there's even potentially more risk with a fully insured plan. So the second provision here on this slide is from a fully insured plan. And if you have people who are covered under your plan who do not meet the insurance carrier's definition, or who you have told Anthem or Cigna or United Healthcare meets the definition of a dependent who is covered under the plan, and that person is enrolled and incurs claims, there's a possibility that the insurance carrier will deny the claim. And then that may potentially convert your plan a little bit into a self-insured plan, because that dependent, if you have communicated the dependent requirements in a manner that's different than what your policy says, or if you have allowed people to be enrolled in the plan and haven't done an audit and haven't removed them from the plan, they would have an argument that they've been led to believe that they are covered, or that these dependents or these individuals are covered under the terms of the plan, and still file a claim under ERISA for the benefit. And that benefit wouldn't be protected by insurance. It wouldn't be covered by insurance. So that's a risk to the employer. Studies show that the average cost for each ineligible dependent under a plan is between $3,000 or $4,000 per ineligible dependent. And so, if you did an audit and found just 10 people who weren't supposed to be covered under your plan, that's a savings. That could be a savings of $40,000. Another reason it's important is if a person is covered under your plan who shouldn't be there and who is not a tax dependent, then there's a question of the taxability. Should the employer have been withholding income taxes and employment taxes on the value of the benefit being offered to someone who's not a dependent? It's the issue that we went through. If your plan ever covered, or currently covers domestic partners, that coverage for a domestic partner is only tax favored if the domestic partner is a tax dependent. It also affects the bottom line, because if you have a self-insured plan, you may be paying claims for people who aren't entitled to benefits. Or if it's a fully insured plan and these individuals who don't belong in the plan cause the rate or have a lot of high claims, it's going to affect your rating when you go through renewal and underwriting. So it affects you there. And there are also ERISA implications, especially if you have a funding mechanism for a self-insured plan and participants have put money into the plan, you have plan assets. If those plan assets are used to pay benefits for individuals who are not participants or beneficiaries under the terms of the plan, you could have an ERISA issue as well. So it's really important, it matters, to get a handle on who is covered under your plan and whether there are any individuals who don't belong in your plan. And really going through this process also helps employees understand the terms of the plan, so that this affects the employee as well. If the insurance carrier denies a claim, and the employee thought that the dependent should have been covered under the plan, if the employee had known ahead of time, that individual may have received proper coverage either through another employer plan or got an individual policy through the exchange. So it also ultimately helps the employees if they understand as well who is eligible for coverage under your plan. So that's why it's a good idea on a periodic basis to do a dependent eligibility audit. This is a way to be a benefit superhero for the employer, is to do an audit to determine whether your plan is covering people who do not belong in the plan. And really the first step of this process is to understand your plan document and your summary plan description. So make sure that your plan document and the summary plan description and the insurance carrier certificate of coverage are all consistent, that the terms in those documents are consistent, and that it accurately reflects who the employer wants to cover under the plan, that the definition of a dependent, a definition of a participant who is eligible for the plan is consistent with the way that the employer wants to define those terms. Make sure all the documents are consistent. Make sure that your definitions of participants, full-time employees, and dependents are consistent with the law, in particular the Affordable Care Act requirements. And then make sure that your plan documents and your plan communications and your employee handbook, anything that describes to employees who is eligible for your plan, is consistent with your insurance policy, your group insurance policy, the certificate of coverage, your SPD, and your plan documents. Make sure everything is consistent. So the first step is to get the employer's house in order, to really identify and make sure that we are telling people who is eligible. And then the second step is then to announce to employees that we're going to have this dependent eligibility audit, and then give them a window. It's recommended to give them a window of 60 to 90 days to remove, no judgment here. We're going to clean this up. You may not have known who is eligible. You may not have realized that your child is no longer eligible for coverage. And so to give them a period of time to remove independence from the plan on their own. And then as far as going forward, the next step is then to require some sort of documentation to substantiate the dependents that the employees are telling you are eligible under the terms of the plan. So a marriage license, a recent tax return for spouses, birth certificates for biological children, adoption records for adopted children. If there's a stepchild, a marriage license, an adoption record, to get some substantiation, just like if you're enrolling them in Little League, that these individuals belong in the plan. And then once you've identified who is in the plan, who is in the plan and shouldn't be in the plan, go through the process of removing them from the plan. But here you have to be careful, because the Affordable Care Act prohibits rescissions of coverage unless there's misrepresentation or fraud, or in the case of divorce, you can have a rescission. That's a retroactive removal of the person from coverage under the plan. So when you go through the final stage of cleaning up the plan and making sure that people who are not eligible for the plan are removed from the plan, there are Affordable Care Act considerations, and there are also COBRA considerations. If the person was never eligible for the plan, the employee signed up their neighbor's son, it's unrelated to them, there's not a COBRA obligation. But if they have been enrolled in the plan, there then may be COBRA considerations depending on when you've caught it and when the person aged out or when the divorce occurred. So there are also COBRA and Affordable Care Act considerations when you get to the stage of actually removing people when there's an audit. So that's one way to be an ERISA superhero, is to protect the employer, protect the plan, save some money, make sure employees understand the plan, and also to go through that process of just knowing your plan documents, and making sure everything is accurate and consistent. All right, so let's move on to one of my favorite topics is Affordable Care Act reporting. And so here's Captain America. So you got a letter 226J. Letter 226J is the friendly correspondence from the Internal Revenue Service when the IRS thinks that you owe an employer shared responsibility payment. You owe an employer shared responsibility payment if the employer doesn't offer affordable minimum value health insurance to at least 95% of its full-time employees. This is for an employer of at least 50 full-time employees. Or if the employer offers coverage, and this is the situation that I most often see. The employer offers health coverage, but the IRS thinks that the coverage was not affordable. So you have employees, full-time employees, who they're offered coverage, they declined your coverage. They went to the marketplace, the Affordable Care Act exchange, and enrolled in coverage and qualified for the premium tax credit. And they qualify for the premium tax credit if the IRS and if the exchange thinks that the coverage offered by the employer was not affordable. And why does the IRS think this? Why would the IRS think that you didn't offer coverage to 95% of your full-time employees? Every time I see this happen, it's almost always because of the Form 1094C. It's not because the employer didn't offer coverage to 95% of its full-time employees. It's because Part 3, Column A, Minimum Essential Coverage Indicator, which is highlighted here, was marked no. So it's either marked no for all 12 months or certain months. As you can see, you can mark it either for all 12 months, or you can indicate month by month whether this is the question here, is whether the employer offered coverage to 95% of its full-time employees. And for some reason, some 1094Cs are being marked no when they should be marked yes. And it usually comes down to some sort of glitch in the software that produces the Form 1095C. But when this happens, it's the most significant employer shared responsibility payment. It's basically the applicable penalty amount for the year multiplied by the number of full-time employees minus 30. And so this is where you get ESRPs, employer shared responsibility payment assessments, in the hundreds of thousands of dollars. And it all goes back most often to the Form 1094C. And this line 23 right here being marked no instead of yes. So a lot of headaches can be avoided if, usually it's a payroll provider or a third-party vendor that's doing the 1094Cs and the 1095Cs. But just double check before they are transmitted to make sure that if you do in fact offer coverage to 95% of your full-time employees, that Part 3, Column A, line 23 is marked yes. Another issue then, the other ESRP is the penalty where you offered coverage to 95% of your full-time employees, but the coverage offered was not affordable, or the IRS thinks that the coverage you offered was not affordable, and you had employees that went to the exchange and qualified for the premium tax credit. And so this is an issue on the Forms 1095C. Again, the 1095Cs are issued to employees, and they're also sent to the IRS along with the Form 1094C. And this is another area that you can avoid some headaches and avoid the letter 226J if you review the 1095Cs and make sure that they're being completed accurately. What I've seen with many clients is the line 14, that's the offer of coverage indicator. So that's telling the IRS, did you offer coverage to the employee? Did you offer it to the employee in dependents? Was it minimum value coverage? If you have a code 1A, that's great, because that tells the IRS we offered compliant coverage and it was affordable. Often we'll see codes 1E, which just means we offered coverage, minimum value coverage to the employee, the spouse, and the dependent. You'll see code 1H, which means we didn't offer coverage, or you'll see, and so those are really the typical codes you're going to put there. We didn't offer coverage, or we did offer coverage. That's great. The problem comes with line 16. And for some reason, we often see when we have ESRPs assessed that the line 16 is left blank. Line 16 tells the IRS, okay, the employer offered coverage, but was it affordable? And so there are codes 2F, 2G, and 2H in line 16. 2F is the W-2 safe harbor, 2G is a federal poverty line safe harbor, and 2H is the rate of pay safe harbor. Whatever safe harbor you use to determine affordability, if you have a code in line 14 that says we offered coverage, there should be a corresponding code in line 16 that says, and it was affordable. All right, it was affordable under the W-2 safe harbor, the federal poverty line safe harbor, or the rate of pay safe harbor. If there's a code 1H that says, well, we didn't offer coverage, that's a problem unless you have a corresponding code in line 16 that says the employee was in a waiting period or the employee was in the initial measurement period. It's a variable hour employee in the initial measurement period. That's a code 2D. So if you have a code 1H, that could be a problem because you didn't offer coverage. If the IRS sees that, they're going to say, the employer owes an ESRP for that month. But then if you have the code 2D, that tells the IRS, no, we don't, because the employee was in a waiting period or a limited non-assessment period. Or you have a code 2A that says the employee was not employed that month, or a code 2B that says the employee was not a full-time employee for the month. So for whatever reason, we're seeing code or line 14 completed correctly, but then a corresponding line 16 code not entered. And when the IRS sees that, the IRS will assume that even if you offered coverage, it wasn't affordable. Or if you didn't offer coverage, the employee should have been offered coverage for the month. So line 16 is critical to make sure that is checked. So there, depending on how many employees you have, there can be a lot of 1095Cs. I would just recommend at least doing a spot check, because if the line 16 codes are not being entered, it's probably going to be a systemic issue that a lot of 1095Cs are not going to have the line 16 code. So it makes sense. It's prudent just to, again, review the 1094C, make sure that it tells the IRS that you did in fact offer coverage to 95% of your full-time employees, and then double check, do a spot check on the 1095Cs to make sure that it's being appropriately reported to the IRS. And almost all of the letter 226Js that I've seen this is why I'm talking about this morning, have come back to these forms. It's just been an issue on the form. So anyway, a way to be a superhero is to make sure that you're, it's exciting stuff, I know, but to review your 1094C and your 1095Cs. The next topic I wanted to talk about is an area that we often see missed, is the issue of voluntary benefits, where we consider the AFLAC coverage, that's the supplemental critical illness insurance, is not really, those aren't benefits we have to file a 5500 for, right? It's just a voluntary benefit. But unless you follow the requirements under ERISA, under the Department of Labor regulations, you can fall into a trap where your voluntary benefits actually are ERISA benefits. So voluntary benefits, again, the typical type of voluntary benefits: accident, cancer insurance, critical illness, life, hospital, short-term disability. And the carriers you see are Aflac, Allstate, MetLife, Guardian, Unum. Why this matters is if you have a voluntary benefit that you have endorsed or that actually should be treated as an ERISA plan, that plan, if there are at least 100 participants, has to be reported on a Form 5500, either included in your wrap plan document 5500 or a separate Form 5500. And a couple years ago, the IRS really increased the penalty, or not IRS, Congress increased the penalties for the failure to file a Form 5500. So the penalties, it's up to $150,000 with the IRS. The Department of Labor penalty is $2,233 per day, with no maximum for the Department of Labor. So it's important to know that if your voluntary benefit is actually an ERISA benefit, that you're filing the Form 5500s. And so how do you avoid the 5500 requirement? Well, the voluntary benefit, the employer cannot contribute to the benefit. The employee's participation has to be completely voluntary. And then the key factor here is the employer does not endorse the policy. And that's kind of a facts and circumstances determination. Are the voluntary benefits included in your employee handbook? Does it say XYZ company, we offer group health, dental, vision benefits, as well as AFLAC critical illness insurance and supplemental disability insurance? And do your communications identify these benefits as being offered by the employer? Are they communicated to employees as being a part of your overall benefits package? If they are, then the risk is that the employer has endorsed these voluntary benefits as being part of their ERISA plans, and that you would require which would require Form 5500. If, on the other hand, if the communication is a representative from MetLife is going to be in the break room this afternoon, and there are materials in there, and they're going to describe, some additional benefits that you may want to sign up for, that's not endorsing. It's making it available, but it's not including them into your benefits packages. Or if you provide communications to employees about the voluntary benefits, have a clear disclaimer that these benefits are not a part of the employer's benefit offerings, that these are independent arrangements between AFLAC or MetLife and employees, to just make it clear that there's a dividing line between the employer's employee benefits and then these supplemental voluntary benefits. Again, I've talked about, these are ways that an employer can be seen to endorse voluntary benefits. If you feel like if you do the analysis and determine that, well, we probably should have been filing 5500s, we actually endorse these policies. There is a delinquent filer correction program with the Department of Labor where the penalty amounts are vastly reduced. And so it's a really good insurance policy to take advantage of the delinquent filer voluntary correction program and file back 5500s for some of these benefits. If in fact you look at it and determine, well, we may have actually endorsed these benefits and we should have filed for 5500s. There's a way here to fix that that's relatively inexpensive. And now to some of the hot topic, the vaccine mandates. Here, we can really, as far as the premium surcharge, we can jack up our health insurance policies premiums if we're two-time vaxxers. That's what I thought was relevant here. But before I get to that, I think, as we were preparing for this program, and then last week, President Biden announced his COVID-19 action plan. A lot of these, and it's been in the media, employers with at least 100 or more employees under regulations from OSHA that are going to be issued are going to be required to be fully vaccinated or tested for COVID on at least a weekly basis before they can return to work. Employers with more than 100 employees are also to provide paid time off for workers to get vaccinated or to recover from COVID-19. All federal workers and government contractors, the president has the authority as a chief executive of the executive branch to require federal workers and government contractors to be vaccinated. And then there are more stringent requirements for healthcare workers. We're going to have regulations from OSHA that are going to be requiring employers with 100 or more employees to be vaccinated. Just before Biden made that announcement, however, Delta Airlines made national news by announcing a $200 health insurance premium surcharge to be imposed on unvaccinated employees. And I was thinking, well, is the surcharge still really relevant in light of President Biden's action plan? I think it still is. Certainly, it's still relevant for employers with under 100 employees. And even with employers with 100 or more employees, the choice under the Biden proposal is either get vaccinated or be tested. Employers still may want to provide incentives for employees to get vaccinated, because some employees may just say, well, I'll just be, test me every week. So employers may still be interested in the possibility of imposing a surcharge on unvaccinated employees for their health insurance premiums. If an employer does that, however, you have to keep in mind that anytime you're dealing with a group health plan, you have to make sure that you're complying with the Health Insurance Portability and Accountability Act, HIPAA, as well as the Affordable Care Act. So under HIPAA, an employer may not charge more for health coverage based on an employee's or participant's health factors. An exception for that is the HIPAA wellness program regulations. So under the HIPAA wellness program exception, you have to limit the amount of the surcharge or the incentive to 30% of the cost of employee-only coverage. You have to give employees at least an annual opportunity to avoid the surcharge. And then you have to offer to individuals who cannot meet the standard an alternative means of avoiding the surcharge. The group of people to whom you have to offer the alternative means of compliance depends on whether we treat a vaccination requirement as an outcome-based wellness program or an activity-based wellness program. Under the outcome-based view, the question is a vaccination the same as meeting a health factor requirement, such as a BMI level or cholesterol level or blood pressure level? If you take that really conservative view, the most conservative view, then any employee who is not vaccinated would have to be given an alternative way to avoid the surcharge, which could be weekly testing or social distancing or remote work or masking. If, however, the program is treated as an activity-based wellness program, then the alternative standard would only have to be offered to employees or participants who cannot get vaccinated because of a health condition. So they have an underlying health condition. The doctor says you can't get vaccinated. You would then have to give the alternative standard to those individuals. I think the outcome-based view is the most conservative approach. Treating the vaccination requirement as an activity-based wellness program is a very reasonable interpretation of the regulations and most likely the correct interpretation. But we don't really have guidance on this. It's kind of a gray area, but most of the commentators are treating the vaccination incentive as an activity-based HIPAA wellness program. So again, the most conservative approach would be to give everyone who's not vaccinated an alternative means of compliance. The less conservative, but I think reasonable approach would be to give individuals who cannot get vaccinated an alternative means of compliance. And then if you're going to impose a surcharge, be very careful about the Affordable Care Act, because the amount of the surcharge is added to the premium when you do the affordability determination. So you may impose a $200 surcharge, which requires the employee to pay an extra $200, but cause the coverage offered to be unaffordable and risk a $338 per month ESRP. So an analysis of the impact of the surcharge on Affordable Care Act affordability compliance needs to be done before a surcharge is implemented. And so with that, I think I'm going to turn it over to Nona, who's going to talk about non-qualified plan elections.
Great. Thank you, Bryden. Yes, we're definitely going to switch gears here. Completely different topic, but still lots of room for superhero success. Non-qualified plan elections, I think the theme that is going to run through all of these slides is timing. And there are two aspects of timing that are very important for ensuring compliant non-qualified deferred compensation plan elections. One is the timing of the payment itself. What is the election choosing as the payment date? The other aspect of timing is when must an election be made? And we're going to discuss that today in more detail. So this is a very fundamental principle of all non-qualified deferred compensation plans since the enactment of Section 409A. Really, and that's been 2005. So these rules have been around for a while, but they're somewhat tricky in their implementation. As I was thinking about this topic, I did see that just in June of this year, there was an update to the IRS's non-qualified deferred compensation plan audit technique guide. And these guides are not, they're not annual. They don't come out all the time. So the fact that we have a recent update is something that, is really a tool to learn from. Fortunately, there wasn't a lot in the guide that changes anything or that added surprises, but it's a good reminder of the basic principles that the IRS is going to look at, and that you will want to look at in either going through your non-qualified plan election process each year, or just doing self-audits, sort of in the nature that Brian described with regard to welfare plans. So, big principles. Non-qualified plans have to comply with IRC Section 409A. What does this mean? This means that there are rules that employees and employers have to abide by when deciding whether to defer compensation and deciding when that compensation will be paid. These are elections that, may relate to deferred salary, deferral of bonus, deferral of other pay. As I noted, the elections involve distribution timing, and even plans that you may have that don't have an employee elective deferral form where each year an individual says, I want to defer 10% of my salary until retirement. Even those types of plans that don't have an elective element really involve elections because of the plan provisions that the employer has put into place are choices about payment timing. And the reason that that comes up, and we'll discuss later, is that sometimes an employer wishes to make a change to plan provisions. It doesn't feel elective. There's nothing that the employee provides input on, but even that change, which may take the form of a plan amendment, needs to comply with these 409A timing rules. So we, in addition to talking about the 4 overarching principles, we'll talk about what might be reviewed on audit. Next slide, please. Okay, key principle. For any deferred compensation plan where an employee is making an election to either take salary or to defer it until a future year, that election has to be made before the calendar year in which the service provider renders services for that compensation. So 2023 salary, an election has to be made by the end of 2022. That's pretty straightforward. This needs to be kept in mind even for employers that have a non-calendar fiscal year with regard to salary. There is more flexibility for bonus deferrals that are tied to a fiscal year period. There's more flexibility for the first year of eligibility for someone coming into a plan, a new hire, for example. And there's, flexibility just inherent in adoption of a new plan, as long as that plan is not sort of an indirect way to get around these rules. And new plans can be put into place mid-year. I think that is something that, sometimes is a question that comes up. There's another special election that I have come to use fairly regularly. This comes up often when there's a desire to allow timing choices for multi-year vesting, often performance-based awards, but sometimes just time-based vesting, but an incentive that someone is going to earn over time if they remain with the company. That deferral period is not backed up quite as far. So into the performance period, a deferral may be able to be made either by the plan's terms or through an election. So really, I think that the key thing to keep in mind on this point is just if you have an award, it can be generally not equity, but a cash-based multi-year vesting award, there's more flexibility. But, should tee that up before making the grant. Next slide, please. This principle, the principle discussed in this slide, is about making changes to elections, and the 498 rules are very strict in that once payment timing is selected, only by jumping through, hoops, definitely, can that timing be changed. Core principles here are the election change has to be made at least 12 months before the payment would otherwise occur. The election has to defer payment for 5 years from the time that the payment would otherwise be made. And, this is seen most often. And it does come up where you have an employee that plans to work much longer than had originally, been contemplated when the plan was put in place. They certainly don't want to retire at 65, and are very comfortable deferring payment until age 70. We see that a lot, but it's certainly not a retirement limited scenario. And the third prong is a little bit, it's a slight variation on the first prong, but the point to remember here is the election needs to occur 12 months in advance of the event or the date that is the selected timing payment. Thank you. Only certain events are permissible payment events. These include specified date or fixed schedule, separation from service, death, disability, an unforeseeable emergency, or a change of control. And in general, adding a new payment event to an existing plan is subject to the 12 months in advance, 5-year deferral rules on the previous slide. There are certain exceptions to that rule, however, for death, unforeseeable emergency, disability, change of control. Next slide, please, Bryden. Thank you. And just wanted to make a point, as you'll see here on this slide, that with change of control, that can occur as a permitted acceleration if a number of regulatory requirements are satisfied. If that is something that were to be on the radar screen for an employer, they would want to make sure that all those I's are dotted before allowing that type of acceleration. And then I guess the last thing that I did want to point out is just practice tips. If you have an outside record keeper, work with that record keeper to make sure that they have records going back as far as elections have been made under the plan. Sometimes when record keepers change, we've seen a little bit of slippage there. So it's very important to regularly check in. Make sure that any election forms are fully filled out, and if any forms are electronic, have it set up so the form is rejected if it's not completely filled out, because otherwise you may have a non-election. And include default elections in a plan document in the event that someone fails to make an election, or despite efforts, the form isn't completely filled out. I think that's all I have. Bryden, next slide. Yes, that is the slide I was looking for. All right, I am going to turn it over now to Mark and Claire. They're going to discuss qualified plans. Thank you.
All right, thank you, Nona. As Nona said, we're going to transition from non-qualified plans to qualified plans, and I hope we're going to take a quick poll just to find out what kind of retirement plans documentation our attendees are maintaining. So,
Unfortunately, Claire, it looks like our polls are not going to be working for today.
Okay.
Well,
So sorry.
that's okay. So a tax qualified retirement plan must be maintained pursuant to a written plan document, and your written plan document can take the form of two different types. We've got an individually designed plan, which, like the name suggests, is written specifically for that employer with all of the terms contained in their own plan document. Or it can be a pre-approved plan, which is maintained by a document provider like a bank or another financial institution or a law firm or another benefits practitioner. And this document provider requests pre-approval from the IRS on the form of their documentation that they comply with all of the terms of the Internal Revenue Code. And then the document provider makes those documents available to the adopting employers. So we were just going to take a poll to see whether most of our attendees are doing adopting pre-approved plans or individually designed plans. Individually designed plans do offer the greatest flexibility, but pre-approved plans also have advantages too. Why are we talking about this today? In 2007, the IRS established a fixed review and pre-approval system for the individually designed plans and the pre-approved plans. The IRS set out a 6-year cycle for the pre-approved plans to be restated and re-approved by the IRS every 6 years. We are now in the middle of the third of these 6-year cycles for 401A defined contribution plans, which include profit sharing plans, 401k plans, money purchase plans. Because we're in the middle of the cycle, the document providers are sending the restated adoption agreements to employers with instructions to adopt, to review and adopt, and the restated adoption agreements must be adopted no later than July 31st. We are seeing the document providers send these documents out maybe for the last 6 or 9 months, and will continue to do so. If you have a pre-approved plan and you haven't heard from your document provider, you will be. And they're calling them, going back to the 6-year cycle and the number of 6-year cycles, they're calling them cycle 3 restatements or third cycle restatements. Previously, like in our second cycle, it was tied to changes required by the Pension Protection Act, and so they were called PPA restatements. Now they don't have a better name for them, so they're called third cycle restatements. So if you get these emails from your document provider with instructions to review and sign, it's important to pay attention to that.
so Claire, what is the significance of this due date, July 31, 2022? What happens if you don't adopt by that date, or why does it matter?
The July 31st, 22 deadline allows the participant, the adopting employer, to continue to rely on the pre-approved status of their plan. If they miss that deadline, they are no longer under that IRS protection of a pre-approved plan. So we can go on to the next slide. So what makes a superhero here? It's easy, just pay attention to the details, right? How easy is that? And why is it so important that we're paying attention, such close attention to these restatements right now? So all of the design choices in your prior adoption agreement should be carried over to your restated adoption agreement, unless you've had some specific amendments adopted during the interim. Sometimes when you're doing a careful review like this, it makes an employer decide, oh, well, we'd like to make some changes. Maybe we'd like to add automatic enrollment. Maybe we'd like to speed up our vesting schedule. This can be a good opportunity to review your whole plan document, the whole grand scheme of the benefits that you're offering in your 401k plan or your profit sharing plan. You can make some changes now. Some changes can be amended back to the beginning of January 1st of 2021. Some changes will have to be prospective. Communicate with your document provider to get any changes made. Run it up the flagpole with your administration and so on, with your management of the company. If you're reviewing your existing adoption agreement and your new adoption agreement and you see errors or inconsistencies, they should be fixed with your document provider before you adopt your new restated plan. If errors are found after you've adopted the plan, that can be a plan failure, because your plan has to be administered in accordance with its terms. And if you have a certain definition of compensation that you had been applying to your plan for the last 4 or 5 or 6 years, and your new adoption agreement that you signed inadvertently has a different definition of compensation that you're using for plan benefits, you're beholden to the document that you have signed, and you would have to make a correction to fix that failure. The IRS has a correction program, but you're not going to feel like a superhero anymore when you're going through this correction process.
Okay, Claire. So if we're going to try to be a superhero, what kind of errors have you found? Where do you see things that need to be addressed?
You could see something like a big one is automatic enrollment. You know, you can automatically enroll people in your elective deferrals, but if you have not known that that box has been checked, and you have not been automatically enrolling your participants in their 401k, you're going to have to go retroactively back to when that box was first checked and bring those people into your plan. These people may have gone. You're going to have to make contributions on their behalf. That can get pretty costly, and you would have to correct that retroactively. Like I mentioned, a definition of compensation. You may think that you're excluding bonuses from your definition of compensation when you're making your matching contributions or your non-elective contributions. But if you have not excluded them on your adoption agreement, then again, you're going to have to go back and make up that missed deferral, a missed employer matching contribution on what was a greater amount of compensation, because you should have included bonuses in your calculation.
Thanks.
Anything else that you see, Mark, that you think of?
These are common. I mean, the ones you're talking about, they're common. I know that if you sign the document, it's hard to get the IRS to go back and say, well, it was just a scrivener's error. It was just a mistake in drafting, because in their opinion, you're responsible for this contract, and they are not going to give you a pass just because you said somebody else drafted this for us, because they're going to say, but they sent you a letter and it said, please review carefully, and then you signed it. So it's hard to try to get the IRS to ignore the document failure. It's much easier to correct it before you sign it.
Correct. So we can go on to the next slide, and just a couple quick notes that are important to know. The restatement process that we're talking about right now is only for, I say here 401A plans. I mean 401A defined contribution plans. Like I said, profit sharing plans, 401k plans, money purchase plans. The pre-approved 403B plans that were adopted, but they're maintained by tax-exempt organizations or schools or universities or churches, they just finished a restatement process last June, so their 6-year cycle will be down the road. Pre-approved defined benefit plan restatements are on a different staggered cycle, and those are due January 31st of 2025. So if you have either of those types of plans, this deadline that we've just talked about is not looming for you. Still doesn't make it any less important to pay attention to the details and make sure that all the terms in your pre-approved document line up with how you're administering it. And also, because of the timing when the document providers had to submit their restated documents to the IRS, they don't include amendments for several recent law changes, one of which is hardship. There were some changes based on final hardship distributions a few years ago. Those amendments must be adopted by December 31st of 2021. Your document provider might have sent it to you as part of the Cycle 3 restatement, or you might have even gotten it a year or so ago. But that is, it's worth checking to make sure that you have adopted those on time. Also, the Secure Act that was signed at the end of 2019 and the CARES Act that was signed in 2020. There are several discretionary amendments, several required amendments in the Secure Act and discretionary amendments in both of those acts. Those amendments must be adopted on the last day of the first plan year that begins in January of 2022. If you have a calendar year plan, that date is December 31st of 22. If you have a non-calendar year plan, that date rolls into 2023. Those amendments will come from your document providers as standalone, or sometimes you call them snap-on amendments, but they also will require your action, but are not part of this restatement. So there's more down the pike.
So Claire, can you explain a little bit about how the amendments to pre-approved plans work?
Some amendments will come without any decisions by the employer. And I'm thinking recently when we had to make amendments for the Code Section 415 benefit limits, or the Code Section 401A9 required minimum distribution rules, those amendments came, there was no discretion in those amendments. And so those amendments may just come from your document provider just to say, this is an amendment. There's going to be sort of electronic signature by your document provider. You just have to keep that as part of your plan file. The three that I just mentioned here, Hardship and Secure Act and CARES Act, all had a few decisions made by the employer. And so the employer will also have to adopt those amendments. Does that answer your question?
Yeah, it does. And that's really important. It's sometimes people just get the amendment from their document provider, but don't realize, oh, wait, this one I'm actually supposed to check an additional box and then sign. And if it's not timely adopted by the individual or by the plan sponsor, then it's not deemed adopted by the IRS in order to preserve your reliance on the pre-approved status.
And we don't really know how some document providers might really be hounding their employers to get these adopted, and some may send them, and it's up to all the individual employers. So to your point, Mark, then we just have to pay attention to what comes from your Fidelity or your Merrill Lynch or your
right. You just don't know whether they're going to follow up with you and do a little hand holding, or they're expecting you to receive it, read it, understand it, and take care of it.
Right.
Well, thanks, Claire. I think on to the next slide. Okay. So the part that I'm going to be talking about is the DOL has established a nationwide compliance initiative to focus on missing participants. And this is such an important issue for plan sponsors. In the past, the IRS, the Department of Labor, and the Pension Benefit Guaranty Corporation, or the PBGC, have repeatedly issued guidance and requirements related to what a plan sponsor must do to identify missing participants, or what they need to do once they've identified those missing participants with respect to their benefits. The Department of Labor sees identifying non-responsive and missing participants as a responsibility of the plan administrator that is subject to the ERISA fiduciary duties. And to assist participants or plan fiduciaries in meeting their responsibilities, the DOL has announced this nationwide initiative. In January, the DOL released 3 pieces of guidance, and the first one of which is the best practices for reducing missing participants. The second is an audit initiative for defined benefit plans that they are calling the Terminated Vested Participant Project. And then the final one is authority under PBGC guidance for defined contribution plans, which normally don't have anything to do with the Pension Benefit Guaranty Corporation, but defined contribution plans to use the PBGC missing participant programs. At the bottom of the slide, you can see there is a hyperlink, or at least the address for a hyperlink that is where you can find the 3 different pieces of guidance from the DOL. At the end of the program, we'll be sending out a copy of the slides, and you will be able to find that again, or you can just shoot us an email and we'll send you a link to it. Let's go to the next slide. Okay, here we were going to have a poll, and the poll was a bit of a cheat, but actually the poll is supposed to come after the slide, so I will wait and tell you what the poll is. Anyway, given the emphasis on regulatory agencies agencies place on missing participants, it's obvious that ERISA superheroes keep track of plan participants. In the new best practices guidance, the DOL advises that the first step to addressing a problem is know that a problem exists. And the DOL has determined that they've audited tons of plans over many, many years, and through their audits, they've found certain red flags, they actually use that phrase, that are warnings or indicators that the plan has a problem with missing or non-responsive participants. So this was going to be the poll. I'll just read you the red flags. And it's instructive to know that they think that this indicates that you have a problem. A substantial percentage of the participants are terminated vested participants, and a lack of a policy handling returned participant notices. So if you get bounce back letters or emails, plan has no procedure for handling uncashed or returned checks, missing inaccurate or incomplete census data or contact information. All of those, the DOL deems are red flags that it should pay attention to, and that plan fiduciaries should pay attention to as indicating that there may be a problem. So let's go to the next slide. So the DOL notes that a common characteristic of plans that have low numbers of missing and non-responsive participants is that the staff are committed to making sure the plan records are complete and up to date, and to proactively take steps to ensure that the participants and beneficiaries get their benefits that they have earned in a timely fashion. In other words, these staff are ERISA superheroes. The DOL groups the different best practices into these 4 categories that are listed here on the slide. And the first is to maintain accurate census records. And they list a bunch of best practices, but among them are flagging undelivered mail, emails that bounce back, and uncashed checks for follow-up. I can't tell you how amazing it is to talk to someone and say, well, here's the drawer where we have all of the uncashed checks that came back. They shouldn't go in a drawer. They should actually be followed up. You should determine what the correct address is and reissue the check and send it to the right address. Another best practice is periodically contact participants and beneficiaries to confirm and update their contact information. And when you do that, make sure that you get as much information as possible. Find out, their cell phone numbers, their landline numbers, their email addresses, perhaps the next of 10. Confirm their marital status. That comes up later in our discussion. Get as much information as you can. Regularly request updates from participants on their beneficiaries. And we'll be discussing that in a few minutes as well. When there's a change with the record keeper, and I think Nona mentioned this in her slides, or if there's a business merger or acquisition involving the plan sponsor, remember to address the transfer of appropriate plan information and relevant employment records. And this is really key. And yet especially when you're in the midst of a merger or acquisition, at the end, everything comes crashing in very, very fast. So I recommend making sure that this gets added to the to-do list at the very top, at the very beginning, so that it can be taken care of over time. One characteristic I think of an ERISA superhero is that the superhero thinks ahead and doesn't have last-minute emergencies. Not always, but not as many as could be. The next of the best practices is to implement effective communication strategies. And here the DOL notes that first, your notices should be clear, they should be direct, they should use plain language, and if applicable, non-English language options would be made available. State upfront what the communication is about. For example, regarding requests for updated contact information or your eligibility to start retirement pensions. This often helps avoiding having that email sent to the junk file or the letter being thrown away. Clearly mark all envelopes and correspondence with the original plan name or sponsor's name if the correspondence is going to terminated vested participants who have maybe been gone for several years. Because you can imagine you've got someone, they work for your company from 1989 to 1999, but it's now been over 20 years. The plan name has changed, the employer name has changed, and they all of a sudden get a message from unknown company. They may not even open the message. They may just pitch it. So it's your responsibility to make sure that they actually get the information. So providing a little additional information can be helpful. Then the next category is conducting missing participant searches. The DOL, the IRS, and the PBGC have all had lists of what you should do. Some of this is really familiar. Check related plan and employer records, check payroll records, HR records, group health records. I once had a terminating plan, pension plan, and they had a list of missing participants and they had done searches for them, and the record keeper had done searches for them. Nobody could find these people. They hired an outside investigator to find the last group of people. It turns out one of them was an active employee who was a participant in the current 401k plan and in the group health plan, but the address in the the pension plan that was being terminated that had been frozen long ago was just inaccurate and just dated. So check other records. Check with designated beneficiaries. If you've got the names of the children or the spouse, go ahead and look there. The employee's emergency contact information, those people may in fact know. If you have their information, you may be able to find them. Go ahead and use free online search engines. Public records, databases, obituaries, and social media can all be a source of finding some information, maybe not their street address or telephone number, but maybe a way to send a message to the missing participants. You can also communicate, use a commercial locator service. This may be a bit costly, but it can be very effective. The DOL added 2 new options that I had never seen before. It's to reach out to colleagues of missing participants, people who still work for you that may know who these people are and where they are. Publish a list on the company's intranet as here are some people we're looking for to let them know about their benefit. Let us know if you have their contact information. Also use registering missing participants in a public or private pension registry. And the DOL mentions the National Registry of Unclaimed Retirement Benefits. I hadn't even heard of it. And so I Googled it, and sure enough, it's a real database. And they list the 3 reasons they exist is 1, help employers find their missing participants, help employees find their benefits, and help estates find benefits that may be due to the estate of a person who's deceased. So finally, and I think this best practice applies probably for all fiduciary actions, document. If there is no written record, you cannot demonstrate that the fiduciary was compliant if you're drawn into an audit or if you're drawn into a court. You must document what occurred. So follow written procedures, develop the procedures based on the best practices that the DOL has issued, and then document what actions were taken and if decisions had to be made. Say we couldn't find somebody, what are we going to do? They've been gone for many years. The plan may allow you to forfeit the benefits so long as they are eligible to come back and get the benefit, but you want to document the steps you took before you actually do that forfeiture. Finally, if the plan has an agreement with the record keeper or a third-party administrator to do certain actions, such as follow up on returned envelopes or returned checks or uncashed checks, then the plan fiduciary should confirm that such service providers are doing what they're supposed to be doing. And if they're not, work with them to come up and be in compliance of any shortcomings. I encourage you to go ahead and find that document for the best practices and download it and review those practices. So on to the next slide. One more slide. Yeah, there. The DOL takes the position that a plan sponsor's inability to pay accrued benefits as a result of inadequate record-keeping practices, ineffective procedures for communicating with participants, or faulty procedures for searching for participants or beneficiaries is in fact a fiduciary failure. And there are consequences for fiduciary failures. So to drive home the significance of this responsibility, the DOL has established the Terminated Vested Participant Project, or TVPP, to avoid defined benefit, to audit defined benefit plans that appear to be in danger. That was the word the DOL used, of failing to provide accrued benefits to such participants and to facilitate voluntary compliance efforts by plan fiduciaries. And when the DOL comes knocking and they tell you you've got the error and that there are penalties, all you need to do is voluntarily comply. So the public guidance advises that the TVPP will focus on investigations on plans that appear to have systematic issues in keeping track of terminated vested participants and beneficiaries and making timely distributions. The TVPP will initiate audits using information they gather, such as large numbers of retired and vested participants who are not receiving benefits, that have future benefits. That's reported on the Form 5500 that the plan files every year. Also, if there's some public record of a merger or transaction, corporate transaction, or a bankruptcy, these are triggers that will draw the attention of the Department of Labor's TVPP audit. If your defined benefit plan falls into either of these categories, we recommend that you review this 5-page compliance release. It's pretty simple, it's short, and make sure that the plan is implementing the best practices to locate any missing participants and beneficiaries. So let's go on to the next slide. Designated beneficiaries. This is such an important issue for ERISA fiduciaries. And I think this is going to have to be our last slide if we're going to get any questions and answered. But designated beneficiaries are really important, and yet they're often missed. The best practice would be to make sure that the plan makes the clear and easy procedure for designating beneficiaries somewhere where they can actually give you the information of who's going to be their beneficiary for the plan, who the participant's beneficiary is going to be, or beneficiaries plural, and also their contact information. And also sending periodic reminders to participants to go back and review their beneficiary designations and to check the contact information to make sure that that information is correct. Children move, and if they're adult children, they may move frequently, but the plan needs to be able to find them and identify them if the participant dies and hasn't taken a benefit. Also, this is really key. It's really important that the participant's beneficiary is clear. After the participant dies, it's difficult to determine who that may be if you don't have a designated beneficiary. It can be time-consuming and occasionally litigious. So I recommend really focusing on making sure that participants keep up to date with their beneficiaries. And one thing that's important is to remember that marital status can affect who a participant's beneficiary is. For example, if a participant was previously married, had a child from the first marriage, designated that child as their beneficiary, then gets married, by operation of law and the plan, the participant's beneficiary is their spouse, unless the participant redesignates that beneficiary with the consent of their current spouse. So if they don't, then the prior beneficiary designation is void. Marital status does not affect beneficiary designations if they get divorced. Some states have tried to put cover-all statutes that say if a person's divorced, the beneficiary designation in their plan is no longer effective. Courts have struck those down because ERISA preempts state law. I recently had a request from a plan sponsor. They had a beneficiary designation naming the former spouse of the deceased person. And the deceased participant had designated that person as their beneficiary, then got divorced. And in the divorce decree and property settlement, it specifically said neither party in the divorce had any claim on the benefits of the other's retirement. But that doesn't control. What controls is what the plan document says. And the plan document says the beneficiary is the designated beneficiary under the plan. And so we had to tell them, no, it can't go to the surviving children who may or may not have been who they intended it to go to. It must go to the person designated under the terms of the plan. And so that's where we went. At this point, I think we have to skip the last two slides and go so that we can have question time. So I'm going to jump to that. It looks like there are some questions out there. I'm going to give you some time to go ahead and add any questions that you may have. In the meantime, go ahead and advance the slide. We have a podcast called the Williams Mullen Benefits Companion, and you can go ahead and sign up for it, or you can get it through Google, Spotify, Apple, or Stitcher. And Bryden leads that, and several of us have been interviewed, and lots of the people who have called in, I think maybe are signed in today, have been interviewed. So it's an excellent podcast. And then also, if any of you are attorneys and you need to get CLE by the end of October, I want to remind you that you can move to the next slide, Bryden. We have our upcoming CLE Institute on October 8th, and we've applied for 5 hours of CLE credit with several states, including Virginia and North Carolina. The event is free, and you can find additional information on the events page of our firm's website. So now let's go to some questions. I saw before that Bryden had several. Bryden, do you want to take some questions?
Sure. One of the questions was whether, going back to individuals who should not be under your plan. So you have ineligible dependents, and whether a participant or the dependent could have a claim for equitable relief under ERISA. And that's really one of my chief concerns, is that if an ineligible person has been covered under your plan for an extended period of time, and there's been no audit or nothing to indicate that person shouldn't be there, that the participant or the ineligible individual could make a claim that, we were led to believe that this person should be covered under the plan, and so you need to provide coverage. And that, if that belief is based on employer communications of who's eligible that are incorrect, or just a failure to catch a dependent that shouldn't be under the plan as a dependent, but then they're continued to be offered coverage, the insurance carrier isn't at fault for that necessarily. So the insurance carrier may say, well, you may have to pay that claim, but we don't have to pay because under the terms of our group policy, that person is ineligible. And so the risk is that the employer would end up having to self-insure the benefit for someone who didn't belong under the plan. There's a question about, how do you determine stepchildren? Just because someone gets married and there's a child living in the house doesn't make the child a stepchild of the participant and therefore an eligible dependent. So there need to be evidence of the adoption of the child for that child to become an actual stepchild under the plan.
So Brian, though, doesn't that depend on how the plan defines what a child is?
It does, yeah. And again, the first step of the audit is to make sure that you understand what the plan says and what your SPD says and make sure all of that is accurate.
Do you want to answer any of these other questions? Or
Yeah,
it looks like we have about a minute left.
The question was, if supplemental benefits are enrolled on an employer's enrollment system, is that considered endorsement? It's a facts and circumstances determination as to whether the employer has endorsed. I would like to see exactly how the voluntary benefits are described in the employer's enrollment portal. So it's not endorsement if the employer payroll deducts, to pay the premium for employees for the voluntary benefits, but it's really how you communicate it to the employees. So I could see there being an enrollment system portal that may list voluntary benefits, but I would want to have very clear disclaimers and language around that to say that we will payroll deduct these premiums as a convenience for employees, but these are not part of the company's employee benefits programs, to have that wall of separation between voluntary benefits and the employer's employee benefit programs.
Well, thanks, Bryden. I think that's all we have for time for questions. Thank you all for joining us today. Please look for an email from us that'll be coming in a few minutes that will have a link to the presentation and also information about the SHRM credit. Please contact us if you have any further questions or would like to make suggestions about future presentations that we can give. Thank you very much and stay safe.
Bye, everybody.